Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the single best-selling tracker fund on the AJ Bell Youinvest platform at the moment, namely iShares UK Dividend. This tracker product is an ETF or exchange-traded fund. It's designed to track or mirror the performance of the underlying assets and deliver that performance minus any running costs. In this case, the tracker is following a specialist index, the FTSE Dividend Plus, with the intention of offering exposure to the 50 highest yielding stocks in the FTSE 350 once investment trusts are excluded. The goal here, therefore, is to generate income for investors, and as I sit here today, the yield on the tracker is some 3.9%. The dividends are paid quarterly. iShares UK Dividend uses direct or physical replication to generate performance, so it owns the underlying securities. The biggest 5 holdings, according to the latest fact sheet, are fund manager Aberdeen Asset Management, oil giants BP and Royal Dutch Shell, megabank HSBC, and engineer Amec Foster Wheeler. Launched in 2005, the tracker's got just over 800 million quid in assets under management, so it should prove fairly liquid, at least under normal market conditions, and the tracker comes with an ongoing charge figure of 0.4% a year. As a final point, iShares UK Dividend is one of the 16 members of the top tracker list used by our investment guidance service, although it doesn't feature in any of the 3 actual model portfolios at the moment. So those are the mechanics. The question now is, why would your fellow investors be buying this product at the moment? And I think there are 2 main reasons. First, the Bank of England cut interest rates on the 4th of August to a record low of 0.25% and hinted it could cut again before year end. Meanwhile, the US Federal Reserve is still pussyfooting about with whether to push through a second rate hike or not to follow last December's, while the European Central Bank and Bank of Japan are still in full-on easing modes. In other words, investors are thinking rates are going to stay lower for longer, and as bond yields have plunged in response, that's driven investors towards stocks in a scramble for income. This chart shows headline interest rates at the big 4 central banks over the past 2 decades. See if you can spot a trend. The next graphic shows how the yield on the FTSE 350 index, which this tracker follows, compares to the so-called risk-free rate, or UK 10-year government bond, or gilt. Anything over the thick black line means stocks are yielding more than bonds. And as you can see that the premium from equities is as high as I can get the data to go back, some 20 years. Note that when the gap has previously reached as much as 2% or 200 basis points, then iShares UK Dividend's prices tended to hit bottom and then rise. The gap is now 2.86% or 286 basis points. Now please remember, the past does not offer guarantees for the future by any means, but I suspect a fair few yield seekers are looking at this with interest. The second reason why investors may be buying iShares UK Dividend Tracker now is that income hunting does have its dangers. Maybe some investors are using this tracker as a diversification tool to tackle stock-specific risk. Around a dozen FTSE 100 firms have cut their dividend over the past 12 to 18 months, and their share prices generally got hammered to make matters worse for anyone holding them. It takes diligence and expertise to study cash flows and balance sheets, and if you haven't got the time or inclination to do the legwork, this tracker provides access to 50 stocks, not just 1 or 2, something that may help provide some protection if more dividend cuts do follow. Now that's not to say the tracker won't have its lumps and bumps, as its standalone performance chart for the last 5 years here does show. Therefore, ultimately you will need to decide whether the iShares UK Dividend Tracker fits with your personal overall investment strategy, target returns, time horizon and appetite for risk before you put any capital at risk, and that's something you must consider as you do your own research. So thank you for watching, and I look forward to seeing you next time.